Hey there, I'm Mr. Ben. If you're someone who wants to understand the mechanics behind wealth instead of just hoping things will magically improve, make sure to hit that subscribe button and give this a thumbs up if it ends up helping you see money differently.
I want to tell you a story about how a pal of mine learned to invest just $100 in the stock market. When he first started, it felt as daunting as walking into a fancy gym full of machines. But really, investing isn't about having big bucks or fancy tools. It's about showing up.
One guide even compares investing to a first gym session. You don't need the heaviest weights, just the mindset to start. As one expert puts it, investing $100 is crucial to establishing a routine and long-term mindset. In other words, that first $100 deposit can build confidence and habits that pay off later. Think of it like putting coins into a piggy bank. It feels small, but the practice of saving and investing is what matters. So I sat down with my friend and explained, with just $100, you can start. Many brokers have no minimums now, and fractional shares let you buy a slice of a big stock. This story is about the mistakes my friend made and the simple steps we took to fix them and grow that $100 over time. Next, I showed him that successful investing starts with a plan. We grabbed a notebook and set some simple goals. Why are we investing? Retirement, a big purchase, etc. And how much risk can we stomach? Investopedia suggests you should identify your goals, timelines, and risk tolerance before investing. In plain terms, we decided what this $100 and future contributions was for, and how long we could let it grow. With that in mind, we sketched a game plan. Invest a small amount every month and stick to it no matter what. This became our roadmap to avoid panic decisions. In fact, setting a written plan helped curb impulsive moves. When he felt anxious about market news, he'd check our goal list and remember, this is for my long-term goal, not a quick win. We also agreed to automate as much as possible, like scheduling monthly contributions, so we wouldn't forget or sell on a whim. The key lesson? Plan ahead. By following Investopedia's advice and writing down our strategy, we turned a flailing first attempt into a disciplined approach.
With a plan in hand, I helped my friend pick the right investing tools for a small budget. First, we needed a brokerage account. We chose one with no minimum deposit and no commissions, so that $100 could go entirely to investments rather than fees. Many modern apps have no strings attached accounts. It's a perfect fit for beginner budgets. Next, I introduced fractional shares. Instead of buying one whole share of an expensive company, fractional shares let you own just a piece. For example, I told him, if a stock costs $500, his $100 could buy 1/5 of a share. It's like buying a slice of pizza. You don't need the whole pie to enjoy it. This means he can invest in big-name companies even with only $100 in hand. Here are the tools we used. No minimum broker or app. Opens account with $0 down and no trading fees. Fractional shares. Buy a part of expensive stocks with $100, e.g., $100 of a $500 stock. Automated investing app. Some apps round up purchases or let you set small recurring buys, great for building the habit. Tax-advantaged accounts. We checked if we could open an IRA, individual retirement account, with no minimum. Many brokers allow this, so our $100 becomes a first retirement deposit. Using these tools meant every dollar of that $100 was working for us. Instead of a risky one-shot trade, we have the right platform and method to invest carefully. To spread risk, I convinced my friend to invest not in one company, but in a fund. Specifically, we looked at ETFs, exchange-traded funds, and index funds. An ETF is basically a basket of stocks you buy with one trade. For example, a broad S&P 500 ETF holds shares of 500 big companies. That means his $100 would be distributed among hundreds of businesses, a concept summed up as diversification on a budget. State Street's guide puts it simply. Your $100 spreads across many companies instead of going all in on one.
Investopedia echoes this, noting the easiest way to diversify is through funds or ETFs that automatically spread your money across many companies. In practice, we bought a fractional share of a broad market ETF, instantly avoiding the fate of a single stock crash. The benefits were clear. Instant diversification. One ETF trade equals exposure to dozens or hundreds of companies. Low cost. Many ETFs have very small fees, expense ratios, so more of our money stays invested. Liquidity and flexibility. ETFs can be bought or sold anytime the market is open, just like stocks. By investing in an ETF rather than a single stock, my friend's $100 was no longer riding on one horse. This step followed the advice to rely on broad, low-cost funds, a safer strategy often suggested for beginners. He felt better knowing one market drop in a single company wouldn't sink his whole $100. One of the most important lessons was learning to be patient. We treated the investment like planting a seed. It wouldn't sprout overnight, but given time, it could grow big. Compound interest is the force that magnifies small investments over decades. As State Street points out, a lone Benjamin may seem insignificant, but those early deposits can compound into something much, much larger. In plain terms, reinvesting dividends and returns lets your money earn money on top of money. To illustrate, I showed him a quick example from an investing guide. If $100 grows at an average 10% per year, it becomes about $200 in roughly 7 years and almost $1,750 in 30 years. That blew his mind. By sticking with it, even tiny monthly additions could turn into a nice sum later. We wrote down a new motto: be patient and give it time. We also planned to reinvest any dividends. Instead of buying a new gadget with a small dividend check, we'd automatically buy more shares. State Street encourages this too. They say reinvesting and staying patient builds momentum over time. So, rather than checking the price every day, he learned to relax and watch the long-term chart. Over weeks and months, his emotions settled, and he saw how even small gains could snowball, reinforcing that time is his greatest ally. We also talked about where to keep the $100. A retirement account, like an IRA, can be a good idea. Many brokers let you open a Roth IRA or traditional IRA with no minimum, so our $100 could start a retirement fund. The benefits are big. With the traditional IRA, you might get a tax deduction now, and the money grows tax-deferred until retirement. With a Roth IRA, you pay taxes up front, but all the future growth is tax-free. This was especially compelling. Investopedia notes that for young investors, decades of tax-free compounding can dramatically boost wealth. In practice, we arranged to contribute small amounts, even $5 or $10 a week from his paycheck, into a Roth IRA. We chose an IRA because it forces us to think long-term. He couldn't easily take that money out for a weekend splurge. This aligned with our goals. By framing it as a long-term, slow-grow strategy, he stayed focused. The big takeaway was clear. Even though we started with $100, we treated it like the seed of a retirement garden, watering it regularly and giving it tax-advantaged soil to flourish. Along the way, we kept a lookout for common traps. One is fees and expenses. When you invest a small amount, high fees can eat a big chunk of your gains. I reminded him of one tip. Pick low-fee platforms and start with simple, low-cost, broad funds. For example, many ETFs charge very low expense ratios. We agreed that anything above about 0.4% annually is too steep for us at this stage, so we picked funds with tiny fees. Some were as low as 0.03%. We also decided to trade infrequently. Every transaction has hidden costs, like bid-ask spreads or taxes. Keeping trades minimal meant more of our money stayed invested. Another big trap is emotion. Whenever he felt nervous watching the market, I reminded him panic selling is usually the worst move, and chasing the next hot tip often backfires. We even put a rule in writing: wait 24 hours before reacting to any market news or stock tip. This calmed things down. By consciously controlling these factors, low fees and steady nerves, we kept the experiment on track. In short, we focused on low-cost, boring investing and on keeping feelings in check. This helped turn mistakes into a learning process and kept that $100 working instead of sitting idle or disappearing in commissions.
By this point, my friend, and maybe you, has a clear checklist to start investing with $100. Here are the steps we followed. Open a brokerage or IRA account. We chose an online broker with no minimum deposit and no commissions. Nowadays, you can even open an IRA with $0. Make sure the platform lets you buy fractional shares or ETFs. Fund and invest. We deposited the $100 and set up a small recurring contribution each month to make it a habit. Then we bought our first investment, a broad ETF. This single purchase spread our $100 across many companies. If you prefer stocks, buy only a fractional share of a solid company, not a full share of a volatile one. Automate and stick to the plan. We set up an automatic buy every month, even $10 or $20. As Investopedia stresses, even $50 or $100 monthly will grow over time. Automation removes guesswork. You buy whether the market is high or low. Review and adjust yearly. Once or twice a year, we check our progress. We rebalance if needed, for example, add more to the ETF if one holding grew a lot. Otherwise, we leave it to grow. The key is consistency and learning. We avoid making it a daily obsession. Following these steps, inspired by experts' advice, turns a one-time $100 purchase into a sustainable investing habit. It's not about getting rich quick, but about getting started right.